every single year, the Brazilian government loses over 417 billion reais to tax evasion.
Which is just a staggering number. I mean, it's hard to even wrap your head around.
It is. It's an almost incomprehensible macroeconomic leak. So the tax authority essentially decided to stop chasing every corner store and, mid-sized vendor.
Right, the small fish.
Exactly. Instead, they pointed this microscopic, highly aggressive auditing laser at the absolute biggest corporations in the country. We're talking the top 0.01%.
The absolute giants.
Yeah. But here is the multi-billion real question, right? When the state actually breathes down the necks of these corporate giants, do they open their wallets and pay their fair share? Or do they just get, infinitely better at hiding their money?
That is the ultimate question.
It really is. So welcome to the deep dive. And before we get into the actual mechanics of this, I do want to offer a very specific, warm welcome to you, the listener.
Yes, absolutely.
Because today's discussion is a special academic activity. It's produced exclusively for the students, researchers, and faculty of the graduate program in accounting at the Federal University of Pernambuco.
Or UFPE, yeah. It is a real privilege to be doing this for you all. The academic community at UFTE is consistently, pushing the boundaries of accounting research.
They really are.
And we're thrilled to tailor this analysis specifically for you. We know that as graduate students and researchers, you already possess a robust baseline understanding of corporate finance, auditing standards, tax structures.
Right, so we aren't going to waste your time on undergraduate level basics.
Exactly. We are diving straight into the deep end of empirical accounting today.
And we are looking at an incredibly rigorous source. It is a 2021 master's dissertation authored by Paulo Bandeira de Luna Jr.
Yeah, developed under the guidance of his advisor, Professor Dr. Giuseppe Trevisan.
Right. And the reason this specific dissertation is so gripping to read is that it tackles this famously opaque subject.
Corporate tax compliance.
Corporate tax compliance, exactly. And it applies this phenomenally clever econometric design to actually isolate the true causal effect of government audits on publicly traded companies.
It really is a masterclass in empirical design. I mean, analyzing tax compliance is notoriously difficult.
Because they're hiding it.
Exactly. Companies actively try to hide the very behavior you're trying to study. You're essentially trying to measure a shadow.
Right.
But what Paulo and Dr. Trevisan did was they found a unique regulatory mechanism in Brazil that allowed them to drag that shadow right into the light.
Which is brilliant.
But to really appreciate the elegance of their methodology, I think we first have to understand the battlefield, right? The environment these companies are operating in.
Okay, set the scene for us.
Well, Brazil is internationally infamous for the complexity of its tax system. We aren't just talking about a high nominal tax burden.
Though it certainly has that.
Oh, absolutely. But it's also about exorbitant compliance costs.
Right, the sheer administrative friction of it all. I mean, I've read studies suggesting that the number of hours a Brazilian corporate tax department has to spend simply to calculate, file, and, remit their taxes.
That's massive.
Yeah, navigating IRPJ, CSLL, PIS, COFINS, ICMS, and all the ancillary obligations. It's among the highest on the planet.
It is a massive drain on corporate resources. Yeah. And fundamental economic theory, going all the way back to Allingham and Sandmo's models of tax evasion.
Right, the classics.
Yeah, it tells us that when you combine a high tax rate with this labyrinthine, highly costly compliance environment, you naturally incentivize aggressive tax avoidance.
And in some cases, outright evasion.
Exactly. The cost-benefit calculus for a corporate board naturally tilts toward investing heavily in ways to shield their revenue. And the Receita Federal do Brazil, the RFB.
The Federal Revenue Service.
Right. They are acutely aware of this dynamic. They know that trying to police the entire economy uniformly is just a fool's errand. They don't have the resources.
So to fund the state apparatus, they implemented a highly targeted whale hunting strategy.
Whale hunting, yes. Which makes perfect logical sense.
Right, because if you have limited audit resources, you don't send your best inspectors to audit a local bakery.
No, you send them to the multinational conglomerates.
So how exactly does the RFB execute this strategy?
Well, they established a permanent, dedicated monitoring structure that focuses exclusively on the absolute largest taxpayers in the country. And the rationale is purely mathematical.
Return on investment.
Exactly. Historically, less than 0.01% of all corporate entities in Brazil account for roughly 60% of the total tax revenue administered by the RFB.
Wait, 0.01% accounts for 60% of the revenue?
Yes. If we look at the data from a few years ago, say around 2018, the RFB flagged fewer than 9,000 9,000 corporate entities for this intensive monitoring.
Right.
But those 9,000 entities essentially hold the keys to the federal treasury.
So it's a highly concentrated risk for the government. But as I understand it from the dissertation, it isn't just a simple binary list, right? It's
Yeah.
not just you were on it or you were off it.
No, the RFB employs a tiered approach, and this is a vital detail because it forms the entire backbone of the study's empirical design.
Okay, break down the tiers for us.
The RFB uses a mathematical cutoff system based on a company's reported gross revenue from 2 years prior.
2 years prior, gone.
Right. If your gross revenue crosses the first threshold, you are placed into what the RFB calls differentiated monitoring.
Or a confinamento differenciado.
Exactly.
Yeah.
This is a heightened level of scrutiny. Think of it as a sort of yellow alert. But if your revenue is massive enough to cross a second, significantly higher threshold,
Then you're in real trouble.
yeah, you are plunged into special monitoring, or a componimento especial.
And this special monitoring isn't just like a standard annual review.
Not at all. It is a permanent, microscopic, prioritized examination by highly specialized, multidisciplinary teams of tax auditors.
Wow.
Yeah, under special monitoring, the RFB isn't waiting passively for the company to file an annual return. They are proactively monitoring the firm's economic behavior in near real time throughout the calendar year.
So they're basically living inside the company's books.
Essentially. They cross-reference internal filings with external market data. They analyze macroeconomic sector trends to see if the company's margins deviate from its peers.
Right.
And they essentially set up camp within the company's financial ecosystem, searching for the slightest hint of non-compliance.
Okay, let me pause you right there. Because if I am an accounting researcher or a graduate student at UFPE listening to this, a massive red flag is going up for me right now.
Okay, what's the flag?
Well, we're talking about setting B3 listed companies.
Yes, the publicly traded ones.
Right. These are massive entities. They already have the big four audit firms.
Yeah.
You know, PwC, EY, Deloitte, KPMG, crawling all over their balance sheets. They have independent boards, audit committees, strict internal compliance protocols, and they are heavily regulated by the CVM, Brazil Securities Commission.
Right, they're under a microscope already.
Exactly. They are already under intense, unrelenting market scrutiny. So why would the government knocking on the door fundamentally alter their behavior?
It's a fair question.
It feels a bit like a restaurant that already employs a ridiculously strict Michelin star internal health inspector, suddenly descending into a panic because the local mayor decided to drop in for dinner. I mean, shouldn't their kitchens already be spotless?
That is a brilliant analogy, but it conflates two very different types of scrutiny.
Okay, how so?
Market compliance and tax compliance might look similar on the surface, but their fundamental objectives are entirely distinct.
Right.
When a Big Four external auditor examines a B3 listed company, their primary mandate is to ensure that the financial statements fairly and materially represent the company's economic reality.
For the benefit of the shareholders and the market.
Exactly. They are looking for material misstatements. They operate on the concept of materiality, but the tax authority, the RFB, operates on the concept of revenue collection.
So an external auditor might look at a highly complex, aggressive corporate restructuring and say, well, it's accurately recorded on the balance sheet, so we will sign off on it.
Right.
Whereas the tax auditor looks at that exact same restructuring and says, you only did this to avoid paying taxes, and we are going to fight you on it.
Precisely the distinction we need to draw. The RFB is hunting for what they term abusive tax planning.
Oh, okay.
There is a vast gray area in Brazilian tax law between illisum, fiscal...
Which is legal tax avoidance, right?
Yeah.
Like choosing a more tax-efficient corporate structure.
Exactly. Between that and evasum fiscal, which is illegal tax evasion.
Correct.
But right in the middle lies aggressive tax planning.
And that's where the battleground is.
Yes. An external auditor might clear an aggressive strategy if it technically complies with the letter of the CPCs, the Brazilian accounting standards. But the RFB has the power to look past the form of transaction and challenge its economic substance.
I see.
If they determine a transaction lacked a genuine business purpose.
A proposito negocial.
Exactly. If it lacked that and was executed solely to starve the government of tax revenue, they will strike it down.
And the consequences of the RFB striking it down are vastly different from an auditor just, issuing a qualified opinion.
Vastly different. The RFB possesses massive punitive weight. I mean, they can levy catastrophic fines.
We're talking big numbers.
We're talking sometimes 75% to 150% of the tax owed.
Wow.
They can initiate prioritized fiscal procedures, summon executives for immediate depositions, freeze assets.
So it's an existential threat.
It really is. For a B3 listed company, being caught in a major infraction by the RFB doesn't just mean paying a fine. It triggers massive contingent liabilities that must be disclosed to the market.
Which tanks the stock price.
Instantly. It can destroy shareholder value overnight. The sheer threat of the state forces a complete recalculation of risk by the corporate management.
That makes perfect sense.
Yeah.
The threat of the state is a uniquely sharp sword. But, this brings us to the core problem for any academic trying to study this phenomenon.
Right, the methodology.
Yeah, if I am designing my thesis right now, the first thing I see here is an insurmountable problem with causal inference.
Endogeneity. It is the bane of every empirical researcher's existence.
Right. Because if you want to know if auditing increases tax compliance, your first instinct is to just run a standard OLS regression.
Sure, compare the monitored to the unmonitored.
Exactly. You take a sample of companies the government audited, compare them to companies the government ignored, and look at the difference in taxes paid. But that is fundamentally flawed.
Because the selection process isn't random.
Right. The RFB is specifically targeting the absolute largest, most complex companies. So the treatment group and the control group are radically different from day one.
That is the textbook definition of selection bias. Yeah. If you observe that the monitored companies pay significantly more taxes than the unmonitored companies, you cannot mathematically prove that the audit caused the increase.
Right. Because they might just be paying more because they're 100 times larger.
Exactly. They operate in more profitable sectors. They have entirely different cost structures. You have massive omitted variable bias.
It's like comparing the daily caloric intake of an Olympic powerlifter to an amateur marathon runner.
Right.
And concluding that lifting weights magically forces your body to consume 6,000 calories a day. The subjects were fundamentally structurally different before the experiment even began.
A perfect analogy.
So if standard regression fails here, how did Paulo Bandeira de Luna Jr. and Dr. Trevisan actually solve this?
They utilized a highly sophisticated econometric technique known as a regression discontinuity design, or RDD.
Okay, an RDD.
Specifically, they employed a sharp RDD with multiple cutoffs. And for the researchers listening, you know that finding a genuine, randomized, natural experiment in corporate finance is like finding a unicorn.
It's nearly impossible.
It is. But the RFB's rigid, mathematically objective rules for determining who gets monitored provided the authors with exactly that.
Because of those strict gross revenue thresholds you mentioned earlier?
Exactly. Let's break down the mechanics of the RDD. The core assumption of an RDD is that if you look closely enough at the cutoff point, the assignment of the treatment.
In this case, being subjected to intense tax monitoring.
Right. The assignment is essentially random at that very narrow margin.
Okay, let me make sure I am visualizing this correctly. Let's say the RFB sets the threshold for special monitoring at exactly 1 billion reais in gross revenue.
Okay.
The author is essentially isolating the companies that are hovering right around that line. So he looks at a company that reported, say, 998 million reais and compares it to a company that reported 1.002 billion reais.
That is the exact mechanism, yes.
And from an operational, structural, and market perspective, a company generating 998 million in revenue is virtually identical to a company generating 1.0002.
They are twins. They likely have similar corporate governance, similar audit quality, similar market pressures.
But because of this arbitrary line drawn by the government, the firm at 1.002 billion is thrown into the nightmare of special monitoring.
While the firm at 998 million is left safely in the lower tier.
That is incredibly elegant.
It really is.
Yeah.
By restricting the analysis to a very narrow bandwidth around the threshold, the author successfully strips away the size effect, the sector effect, the structural differences.
He essentially mimics a randomized control trial right at the margin.
Exactly, isolating the pure causal impact of the audit.
It is a beautiful application of econometric theory. But, as any rigorous academic will point out, an RDD is only valid if the running variable...
The variable used to determine the cutoff.
Right. It's only valid if that variable cannot be manipulated by the subjects.
And there it is.
That is the exact question I was waiting to ask. Because if I am the CFO of a massive B3 listed corporation and my internal projections show that we are going to hit 1.002 billion reais in revenue this year, and I know that crossing the 1 billion mark will invite an army of federal tax auditors into my life for the next 12 months.
You're going to
I am not going to just sit there and let it happen. I'm going to call my accounting team and say, find a legal way to defer $5 million in revenue recognition to Q1 of next year.
Of course.
I will massage the numbers to report $995 million, stay under the radar, and avoid the audit completely. And if companies are actively self-selecting out of the treatment, the assumption of randomness at the threshold just collapses, right? The RDD is ruined.
Your instinct is spot on, and this is known in the literature as manipulating the running variable.
Okay.
If companies have precise control over their assignment, you will see a statistical anomaly in the data. You will see a missing mass of companies just to the right of the cutoff.
Because they all fled.
Because they all fled, exactly. And you'll see a massive, unnatural clustering of companies just to the left of the cutoff, huddled safely under the radar.
So the burden of proof is really on the author to demonstrate that this clustering didn't happen.
Yes.
But how do you mathematically prove a negative like that?
You use a formal statistical procedure, most commonly the McCreary density test.
The McCreary test.
Right. The McCreary test essentially analyzes the probability density function of the running variable, so gross revenue. It checks if the distribution of companies across the cutoff is smooth and continuous.
Okay, so if the density function drops off a cliff right at the threshold.
You have evidence of manipulation.
Got it.
But when the author ran the McCreary test on this data set, the results were definitive. There was no discontinuity in the density.
Really?
Yeah, there was no unnatural clustering just below the threshold. The distribution was perfectly smooth.
That is fascinating. But it begs a massive behavioral question for me. Why on earth didn't they manipulate it?
Yeah.
We're talking about the most sophisticated financial minds in the country. They utilize complex derivatives, offshore havens, massive corporate restructurings. You were telling me they couldn't figure out how to defer a fraction of a percent of their revenue to avoid a federal audit.
It isn't a lack of sophistication at all. It is a structural impossibility created by the bureaucratic design of the RFB.
What do you mean?
Remember earlier when I mentioned how the RFD determines who gets monitored?
Yeah, the tiers based on revenue.
Right, but they don't use the current year's revenue. They base eligibility on the gross revenue from 2 years prior.
Ah, what we would call year T-2.
Exactly.
Wait, so if the RFB is compiling the monitoring list for the year 2018, they are looking at the revenue the company reported back in 2016.
Exactly. And here is the genius, or perhaps just the happy bureaucratic accident, of this system.
Okay.
The RFB only publishes the exact monetary value of the cutoff threshold via a normative instruction in December of the year before the monitoring begins.
Oh, wow.
You see the trap now.
I do. So December of 2017, the RFB announces the cutoff for 2018 monitoring will be 1.5 billion RIAs based on your 2016 revenue. It's a temporal impossibility. To manipulate their way out of a 2018 audit, a CFO would have had to possess a crystal ball back in 2016. Perfectly predict the exact threshold the RFB would arbitrarily set in December of 2017.
And alter their 2016 financial statements in real time.
Which is impossible. By the time the threshold is announced, the 2016 financial statements have been closed, audited by the Big Four, published to the CVM, and filed with the government for years. They are locked in stone.
Precisely. Because of this lag, the running variable is highly predetermined. It is practically immune to precise manipulation at the margin. A CFO simply cannot alter the past.
That is amazing.
And this bureaucratic friction completely validates the causal inference strategy of the dissertation. The assignment around the threshold is, for all econometric purposes, exogenous. It's as good as random.
I have to admit, as someone who loves elegant research design, that is incredibly satisfying. It's a bulletproof setup.
It really is.
Okay, so we have established that the methodology is ironclad. We are comparing fundamentally identical companies right at the boundary line, and we know they couldn't cheat the selection process. The stage is set.
Let's get to the results.
Yes. What actually happens to a massive, publicly traded Brazilian corporation when the RFB puts them under the microscope?
Well, the headline findings are absolutely striking, but they require a layered interpretation. Let's start with the most intense intervention, the special monitoring group.
The highest tier.
Right. When these corporate giants were subjected to this relentless permanent audit, Their reported gross revenue spiked by a highly statistically significant 12%.
12%.
Yes, and it wasn't just top-line fluff, right? Their reported net revenue also jumped by 10%.
A 12% jump in gross revenue. I mean, for a company doing billions of rays in volume, that is not a rounding error.
No, it's Matt.
That is hundreds of millions of rays suddenly appearing out of thin air. The clear implication here is that prior to the audit, they were successfully suppressing or hiding roughly 10 to 12% of their revenue from the tax authority.
That is the most logical deduction. The intense cross-reference scrutiny of the RFB essentially dismantled their revenue-shielding mechanisms.
Wow.
Interestingly, though, the author found that for the companies slightly further down the ladder, the ones that only crossed the first threshold into differentiated monitoring.
The yellow alert tier.
Right. There was no statistically significant change in their reported revenue.
None. Why do you think that is? Is differentiated monitoring just a paper tiger?
It's a good question. It could be that the perceived threat of differentiated monitoring simply isn't severe enough to alter the behavioral calculus of management.
Like they're willing to risk it.
Exactly. Alternatively, it might be that companies at that slightly lower tier haven't yet developed the highly sophisticated, opaque revenue-hiding structures that the true giants use. So there was less hidden revenue to uncover in the first place.
That makes sense.
But for the absolute largest firms under special monitoring, the revenue spike is undeniable. It's robust.
Okay, so let's put on our public policy hats for a second.
Yeah.
If I am the Minister of Finance, I am looking at this data and I am thrilled.
You'd think so, yeah.
My whale hunting strategy worked perfectly. I deployed my specialized audit teams. I forced these massive corporations to stop hiding 12% of their revenue, which means their taxable profit base just expanded significantly.
Right.
And therefore, the federal treasury is about to collect a massive, massive check. I mean, that is the entire point of the exercise, isn't it?
If we look at this through a simplistic linear lens, that is exactly what you would expect. More revenue equals more profit, which equals more corporate income tax, IRPJ, and CSLL.
Right.
But the data reveals something far more complex and, frankly, far more fascinating. When the author analyzed the actual amount of taxes paid by these companies, the results were incredibly counterintuitive. On average, despite reporting 12% more gross revenue, there was absolutely no statistically significant increase in the taxes paid by these companies to the government.
I'm sorry, I need you to walk me through the math on that because it seems impossible.
I know.
If my top line grows by 12%, unless my operations suddenly became drastically less efficient overnight, my bottom line has to grow. Did their profitability increase?
No. And that is the crux of the issue. The empirical data showed no significant increase in their profitability metrics.
Oh, none at all.
None. Whether you look at earnings before interest and taxes, so EBIT, return on assets, ROA, or return on equity, ROE, the profit margins remained stubbornly flat.
Oh.
The revenue popped up dramatically, but the profit did not. And because the corporate tax is levied on profit, not gross revenue, their tax liability remained perfectly flat.
So how on earth did they achieve that? What is the actual mechanical reality happening inside the accounting departments of these firms?
It's a game.
It sounds like a high-stakes corporate game of whack-a-mole. The RFB forces them to stop hiding revenue, so the revenue pops up. But the company knows that if that revenue flows all the way down to the bottom line, they're going to face a crippling tax bill.
Exactly.
So they have to immediately find a way to squash the taxable profit back down.
That is the perfect analogy. And the true brilliance of this dissertation is that it doesn't just point out the anomaly. It digs into the financial statements to find the countermove.
Okay, what's the counter there?
The author analyzed the expense structures of these firms and discovered exactly how they played the whack-a-mole game. When the revenue spiked, these companies concurrently and aggressively increased their reported cost of goods sold, or COGS.
Which our Brazilian listeners will know as CPV, Custos Produtos Vendidos.
Exactly. The COGS countermove.
Okay.
The statistical analysis demonstrated that roughly 50% of the entire revenue increase generated by the special monitoring was perfectly mathematically offset by a simultaneous jump in their reported COGS.
Just entirely neutralizing the gain. Okay, let's explore the reality of that. Because you can't just invent expenses out of thin air.
No, of course not.
Especially not as a B3 listed company under the watchful eye of a Big Four auditor. You can't just write miscellaneous expenses 100 million raise on the income statement.
Right, they'd flag that immediately.
You have to comply with the CPCs, the Brazilian equivalent of IFRS. So if I am the controller of one of these firms, the RFB is watching my revenue line like a hawk. I have to recognize that 12%,
Yes.
but I need to kill the profit. What are the legal, aggressive accounting maneuvers I can execute to inflate my KGS without triggering a fraud investigation by the CVM?
This is where accounting theory meets behavioral reality. Management has significant discretion within the bounds of IFRS and the CPCs. They aren't committing fraud, they are aggressively optimizing allowable estimates.
Okay, give me an example.
For instance, under CPC 16, which governs inventory, a company might suddenly decide to aggressively write down the value of their inventory, citing obsolescence or market devaluation.
Oh, and that write-down hits the income statement immediately as a cost, reducing profit.
Exactly. Or they could look at CPC 27 for property, plant, and equipment. They might review the useful life of their manufacturing assets and decide, actually, these machines are depreciating much faster than we originally estimated.
Right, so they accelerate the depreciation expense, which inflates the cost of production and suppresses the net income.
Precisely. They might also pull forward planned operational maintenance expenses, recognizing them in the current period rather than deferring them. They might aggressively provision for contingent liabilities under CPC 25.
So they have a whole toolkit.
Yes. The point is, these massive corporations have immense accounting agility. And the dissertation provides a stunning piece of temporal evidence to support this behavioral theory.
What's that?
The author found that this massive spike in KGS did not occur evenly throughout the calendar year. It was heavily, disproportionately concentrated in the fourth quarter.
Because corporate income taxes are calculated on annual profits. This makes perfect sense. Throughout the year, they are operating under the intense RFB audit. They see their reported revenue spiking quarter over quarter.
They're watching the numbers go up.
Right. They reach November, the CFO runs a projection, and sees a massive looming tax liability on the horizon. So, before the books close on December 31st, they execute a coordinated, massive year-end adjustment.
A Q4 dump.
Yeah. They scour the balance sheet for every possible allowable expense, write down in provision, and they dump it into Q4 to neutralize the profit before the tax bill crystallizes.
It is a masterful, if cynical, display of corporate agility. They comply precisely where the state is applying the most pressure, the revenue line.
Yeah, but they dynamically optimize their cost structures in the shadows to protect their cash flows and shield their shareholders from the tax burden.
Exactly.
So let's summarize the policy outcome here. Because the government spends millions of reais employing highly trained, specialized auditors. They spend an entire year breathing down the necks of these massive companies. They successfully force the companies to report significantly more revenue. And at the end of the day, on average, they don't collect a single extra dime in taxes.
It sounds bleak.
It sounds like a colossal failure of public policy.
And if you stop reading the dissertation at the average effect, you might reach that conclusion. But this brings us to what I consider the most profound and valuable contribution of Paulo Bandeira de Luna Jr.'s work.
Okay, let's hear it.
In econometrics, averages can be incredibly deceptive. They smooth out the underlying reality.
Right.
The author didn't settle for the average. He sliced the data to examine the heterogeneity of the impact. He separated the companies based on their absolute size and their baseline level of tax aggressiveness.
Okay.
And when he ran the analysis on those specific subgroups, two entirely distinct, fascinating corporate personas emerged.
I love when data reveals behavioral archetypes. It's like watching two different species of apex predators react to the exact same environmental threat. Let's look at the first persona. You referred to them as the giants.
Yes, the giants. The author defined the subgroup as the companies whose total assets were above the median of the already massive sample.
Okay, so the absolute titans of the Brazilian economy.
The megacorporations. For these specific firms, the RFB's special monitoring was not a failure. It was phenomenally, overwhelmingly effective.
How so?
When these giants were audited, their gross revenue didn't just go up by the 12% average. It shot up by a staggering 20.3%.
20.3%.
Yes.
That is an astronomical adjustment. For a conglomerate with assets above the median, a 20% swing in revenue represents billions in previously shielded economic activity.
It does. But the crucial difference between the giants and the average is what happened to the bottom line.
Did they do the COGS countermove?
They tried, but these massive firms couldn't just expense their way out of a 20% revenue spike. The sheer volume of the adjustment overwhelmed their ability to artificially inflate KGS.
Wow.
For this specific subgroup, the taxes they actually paid to the government increased by a statistically significant 8.9%.
Okay, so the whale hunting strategy does work. You just need a big enough harpoon, and you have to aim for the absolute biggest whales.
Exactly. The return on investment for the RFB when auditing these absolute giants is highly positive, and the data even revealed a secondary behavioral shift.
What was that?
These companies had to significantly increase their liquidity ratios. They were essentially forced to hold more cash on hand, specifically to cover the newly enforced heavier tax burden. The state's enforcement mechanism worked exactly as intended.
But then we have the second persona, the ones who didn't surrender, the group you called the aggressive evaders.
Right.
The holdouts. To isolate this group, the author looked for a classic academic proxy for tax aggressiveness. He identified the subgroup of firms that routinely report a return on assets, or ROA, that hovers incredibly close to zero.
Okay, let's unpack that for a second. Because if I am an investor, a company with an ROA near zero looks like a terrible investment.
Right, it means management is generating almost no profit from their massive asset base.
Exactly. But in the context of tax literature, an ROA near zero isn't usually a sign of operational incompetence. It's a sign of accounting brilliance.
Yes, it is.
It means they are artificially depressing their net income to exactly the point where they owe virtually nothing in corporate taxes.
Precisely. These are the companies employing the most aggressive, sophisticated tax lawyers and accountants in the country. They utilize complex international transfer pricing schemes, debt shielding through intercompany loans, convoluted corporate holding structures in tax havens.
Yes, all of it, to systematically wipe out their domestic taxable income. So the crucial question is, what happened when the RFB threw these apex evaders into special monitoring?
They must have fought back.
They did. When subjected to the intense audit, the RFB successfully forced them to report more top-line activity. Their reported revenue went up by between 13.9% and 16.5%.
So the state won the battle on the revenue line.
Yes.
But did they win the war on the bottom line?
They did not. Despite the massive revenue increase, these highly aggressive firms successfully avoided paying any additional taxes. Their tax bill remained flat.
They completely absorbed the blow.
They did. They possessed the complex corporate structures and the abusive tax planning capabilities to entirely absorb the shock of the audit.
Unbelievable.
They yielded the revenue reporting because the scrutiny was too intense to hide it, but they immediately deployed their vast arsenal of expense optimization and profit-shifting mechanisms to protect every single tax dollar. They outmaneuvered the state.
This is where the narrative shifts, I think, from being a story about tax policy to a profound lesson in corporate governance.
I agree completely.
Because if I am a graduate student at UFPE listening to this, I'm immediately thinking about the shareholders of these B3 listed companies. Is tax avoidance actually good for the outside investor?
That is perhaps the most important theoretical question raised by this entire body of research, and the dissertation elegantly connects its findings to agency theory,
Right.
specifically leaning heavily on the seminal literature by Desai and Dharmapala from 2006 and 2009.
Let's dive deep into agency theory here. Because the traditional, somewhat simplistic view of corporate finance is that tax avoidance is a straightforward transfer of wealth from the government to the shareholders.
Exactly.
Management finds a loophole, saves 100 million reais in taxes,
Yeah.
and that 100 million reais is distributed to the shareholders as larger dividends or reinvested to boost the stock price. Under that view, shareholders should applaud aggressive tax evasion.
That is the traditional view, yes. But agency theory introduces a critical friction: the separation of ownership and control.
Right. The managers running the company are not the owners.
Exactly. And as Desai and Dharmapala pointed out, the mechanisms required to successfully hide money from a sophisticated tax authority like the RFB are not simple. You cannot just underreport revenue on a simple spreadsheet.
Right. You have to build a labyrinth. You have to create off-balance sheet entities, establish opaque transfer pricing agreements with subsidiaries in low-tax jurisdictions.
Just shell companies.
Yeah, shell companies. You artificially obscure the true origin and destination of the firm's cash flows.
Exactly. You have to build an incredibly complex, opaque financial architecture. But here is the critical insight of agency theory.
What is it?
A labyrinth designed to hide money from the taxman is equally effective at hiding money from the shareholders.
Oh, that is a brilliant point. The obfuscation serves two masters. If I am a corrupt or, self-serving CEO, and I have built this massively complex structure to dodge IRPJ and CSLL, I can easily use that exact same structure to extract private rents for myself.
Precisely. High levels of corporate tax avoidance often correlate strongly with high agency costs.
Because of the opacity.
Yes, the managers use the opacity created by tax planning as a cover to engage in self-dealing, excessive executive compensation, empire building, or simply to mask poor operational performance from the board of directors. The interests of the insiders diverge sharply from the interests of the outsiders.
So when the RFB aggressively steps in and forces one of these companies into special monitoring, what is the ripple effect on that agency conflict?
The RFB acts as a massive disruptive force, even if the state doesn't manage to collect more taxes, as we saw with the aggressive evaders who use the COGS countermove.
Right.
The very act of the intense audit forces the company to dismantle some of that labyrinth.
Right. The data showed that the audit forced them to report 12% more gross revenue. It forced them to bring hidden economic activity back onto the balance sheet.
Exactly.
And for the giants, it forced them to increase their liquidity, holding more visible cash.
By forcing better, more transparent accounting, higher reported revenue, and stronger liquidity, the government is inadvertently acting as a heavy-handed, highly effective external monitor.
Wow.
The intense scrutiny limits the managerial flexibility to hide cash flows. It reduces the cover that executives have to extract private rents.
That is a phenomenal theoretical conclusion. The government's whale hunting audit strategy might be designed to fight tax evasion, but its secondary effect is that it actively fights corporate corruption and reduces agency costs within publicly traded firms.
Yes, it forces management into the light.
Which directly benefits the minority shareholders who otherwise wouldn't have the power to demand that level of transparency.
Absolutely.
It perfectly illustrates that the corporate ecosystem isn't just a bilateral struggle between the taxpayer and the state. It is a tri-party dynamic involving the state, the corporate insiders, and the outside shareholders.
A complex dance.
Yeah. And when the state turns up the heat on the insiders, the balance of power inherently shifts toward greater accountability for the outsiders.
It is a beautifully complex dynamic, and it really highlights why empirical accounting research is so vital. We aren't just looking at numbers on a page. We are observing the strategic interplay of highly sophisticated actors reacting to massive institutional pressures.
This has been an absolutely phenomenal breakdown. We've covered an immense amount of ground today. For our listeners, the students and researchers at UFTE, let's sort of synthesize the core takeaways from this deep dive.
Sure.
The foundational finding of Paulo Bandeira de Lina Jr.'s dissertation is that the Brazilian federal revenue strategy of targeted, intensive special monitoring undeniably alters corporate behavior.
It does.
Using a rigorous regression discontinuity design, the study proves that audits cause a statistically significant 12% spike in reported revenue among the largest firms.
Yes, but the outcome of that behavioral shift is highly heterogeneous.
Right.
On average, companies execute a sophisticated countermove, aggressively inflating their cost of goods sold in the fourth quarter to neutralize the profit and avoid paying additional taxes.
But when we segment the market, we see that the state's strategy is highly successful against the absolute giants of the economy, forcing them to report 20% more revenue, increasing their actual tax burden by nearly 9%, and improving their overall liquidity.
While conversely, the highly aggressive evaders treat the audit as a complex game of chess. They yield the revenue line to appease the auditors, but leverage their vast tax planning capabilities to perfectly shield their bottom line.
Protecting their cash flows.
Yes, protecting their cash flows while inadvertently providing more transparency to their shareholders due to the increased scrutiny.
It is a living, breathing ecosystem of regulation, evasion, and adaptation. Which leaves us with a provocative thought. Something for you to mull over as you design your own research models, regressions, and theoretical frameworks.
What's the thought?
Well, we have seen empirically that this incredibly costly, resource-intensive monitoring strategy really only yields positive financial returns for the state when deployed against the absolute largest corporate giants.
Right.
The slightly smaller, aggressive firms simply optimize their expenses and slip the net. So, given the massive cost of employing these specialized federal audit teams, is there a point of diminishing returns?
That's a great question.
Should the government continue to try and expand this monitoring strategy down into mid-market firms, hoping to cast a wider net? Or does this research suggest that the state should accept a strategic compromise, focusing its firepower exclusively on the top 100 megacorporations and accepting that the mid-sized evaders will always find a way to win the whack-a-mole game?
Answering that question requires precisely the kind of rigorous, data-driven causal inference that this dissertation modeled so beautifully. It requires understanding not just the law, but the behavioral economics of the firm.
And if wrestling with complex, high-stakes, real-world questions like that excites you, you're exactly where you need to be. We want to end today by encouraging you to take your intellectual curiosity to the absolute highest level.
Yes, please do.
If you are intrigued by this caliber of cutting-edge empirical research, you should seriously consider advancing your academic journey by pursuing a master's or doctorate at the graduate program in accounting at the Federal University of Pernambuco, UFPE.
Absolutely. It is an elite academic environment where you are given the tools, the mentorship, and the rigor to produce research that doesn't just sit on a shelf, but actually decodes the realities of the market and influences public policy.
The methodological training and the academic culture at UFPE are truly exceptional. The field of accounting needs sharp, analytical minds to continue unraveling these complex corporate dynamics, and there is no better place to hone those skills.
I couldn't agree more.
Often when we talk about auditing or financial regulation, there's this public expectation of precision. It's treated like engineering or medicine. You look at an X-ray, you see the broken bone, and the doctor says, there is the problem.
Right.
But when you step into the world of complex corporate tax behavior, that X-ray machine is fundamentally broken. The diagnostic landscape is murky, intentionally obfuscated by brilliant minds trying to protect capital.
Companies hide, they adapt, they execute countermoves in the fourth quarter.
Exactly. But as we have seen today, with the right statistical lens, with tools like regression discontinuity design, you can cut through the noise. You can finally see the bones of the operation. So keep hunting for those unicorns in the data. Thank you for joining us on this deep dive.